My main focus point today is about passive investing. And passive investing started really in 1976. The Vanguard 500 was launched by Jack Bogle. And passive investing is not just about following an index, but it's really about cap-weighted index strategies. That's what the S&P 500 is. That's what the NASDAQ 100 is. So you buy the S&P, SPY, you buy the Qs. That's what you're investing in. And these are now dominant in investors' portfolios and it has reshaped the entire stock market. And it's increased the correlation of the stocks in that same index. It's also diminished diversification and really eroded price discovery. So it's been really bad for the ultimate true function of capital markets, which is to have buyers and sellers make decisions based on the quality of the companies, the valuations of the companies that are out there in the marketplace. Unfortunately, passive products are the exact opposite. They allocate solely based on market price and mainly recent momentum. And now 53% of flows into equity markets are through passive vehicles. So they have outstripped active management. And global net inflows reached nearly $2 trillion into passive investments in 2024. And investors withdrew $450 billion from actively managed funds last year, up from $413 billion that was pulled out in the previous year. And what happens here is that when somebody goes and buys a passive investment vehicle, the index provider is just simply buying more of all the names within that index, and they're buying more of the bigger names. And so you wonder why you have the Mag 7. You wonder why you have these multi-trillionaires. It's because of these vehicles, of these passive vehicles. They're the main reason why Jeff Bezos is worth hundreds of trillions of dollars. Same with Mark Zuckerberg, etc. This is the mechanism. And more passive flows are crowding out active management that are trading on fundamental information. So you wonder why, if the market's, expensive and, why these names are trading at high valuations and why it continues to do so, is if it's in these indices, these flows are what's driving and perpetuating these overvaluations. But it also works the same way, just like in 2022 when you saw the NASDAQ was down 33%, because that's where most of the concentration of those big names are. And why a lot of those names were down so considerably that year, because suddenly the flows went in reverse. Now, what's interesting is I have not seen a true layoff cycle. That's where most of these flows are coming from, is passive investment vehicles, target dated funds from 401ks. And when people have jobs, they're paying into that. And due to trying to only solely focus on low fees, the unintended consequence is that it's making the market far less efficient. And so stocks in these indices have rising betas, meaning they move together. And this also weakens diversification, right? The whole idea of a broad index of 500 names is that you have this diversification among different sectors, etc. But if you go look at the S&P, for example, it's just a handful of sectors. There's very little in energy or basic materials or utilities. It's mainly in, let me go pull this up right now. I'll keep talking as I'm pulling it up. It's mainly in technology. That's the vast majority here. You're also in financials. Okay. Also in, I believe, consumer discretionary. I finally got it up. Consumer cyclicals, 10.5. Financial services, 13.75. It's called 14% there. Technology, 34%. Communication services, 9.7%. So call it 10%. And then healthcare, 9.5%. So those are the sectors that you're in. You're very little, 2.4% utilities, Consumer defensive only 5.5. Industrial is only 7.8. Energy only 3. Base materials 1.7. And real estate only 2. So you're not getting really diversification. You're getting a very concentrated portfolio, and they're all moving together because they're in the same indices or in the same index. So it's increasingly driving stocks with different business models. They're driving them up and down together. And once again, this is the exact opposite of what capital markets are supposed to be doing. And it magnifies systematic risk in the portfolio, right? Or in the markets. If you get a down cycle where flows start to reverse for various reasons, it's all going to reverse together, and then who's going to be the natural buyer? So this all erodes price discovery in markets. Cap weighted do anyway. And so it increases momentum. So stocks that are going up, that are worth more, they get more of the dollars, and that becomes self-fulfilling. And this feedback loop is, once again, not healthy. Now, passively owned stocks exhibit near zero or mildly positive momentum exposure, but actively held stocks display consistent negative positioning, meaning that ones that are owned, companies that are owned within these indices, they have a stronger momentum factor to them than ones that are not in the indices. So it's showing you here that these aren't going up nearly as much because the business is great. It's just simply money's flowing. They're in the index and money's flowing into the index. And the question is, at what point is the market no longer efficient? If we're at 53% now of passive flows, is it 60%? Is it 70%? Is it now? And I'm increasingly arguing that it is now. Now, if you look back in previous cycles, a good example of this is the dot-com bubble. Back then, still market cap weighted, and the market went down considerably. But if you look at other funds that were more based on fundamentals, so either equally weighted indices or those that were based on some sort of fundamental data, whether that's cash flow or value indices, for example. From 1995 to 2005, the S&P generated an annualized return of 11.4%. 95 was the start of kind of the start of the boom in the equity markets, in the dot-com bubble. And so that 10-year period, that's still good returns, 11.4%. But over the same period, the Russell 1000 Value Index returned 13.2%. And the equally weighted S&P, so same stock, just equally weighted, rebalancing consistently, returned 13.6% annualized over that time period. That's 2.2% premium by having the same stocks, just simply equally weighted. 2.2% per year over a decade. You compound that, that's 30+% delta over that decade. So what it's saying here is that these passive funds and the legislation around investing in just indexes, market cap weighted indexes, they're bad for markets. They're bad for society. They're bad because it's forcing the average person to go put more money in the largest companies versus companies that have better fundamentals, better valuations, etc. I think all passive indexes should be equally weighted. I think we should do away completely with market cap weighted indexes. It would make the market more efficient. It would make society more evenly distributed and not huddle everyone's capital towards just the biggest names in the world. That's my take, and that's what the numbers are saying when you dig into it.